The coronavirus pandemic is leaving millions of people without jobs and struggling to keep up with loans. And as a precaution, major card issuers are reining in lines of credit. Joining me now is Roger Hochschild, the CEO of Discover. Roger, thank you so much for joining me. You have had hundreds of millions of customers now skipping payments. You've been factoring in higher levels of unemployment as you have booked maybe $1 billion or so of provisions for credit losses. What is your expectation over the next couple of months on how consumers across America will be spending and their ability to pay back loans?
So clearly, in my 25 years, we've never seen this much distress for the U.S. consumer. If you think about the roughly 26 million unemployment claims since late March, we're seeing sales volume on our cards down nearly 30%. It's all going to depend on the pace of the recovery and how quickly the economy gets going, consumers get back to work and spending again.
So the pace of recovery is quite interesting. When I was looking at your earnings results, you had been forecasting some pressure into 2022. Can you explain your thinking on the length of that recovery?
Sure. I think there will be a hopefully relatively short-term disruption. So as we think about the programs we're putting out there for our customers, we're actually modeling a lot of those on the type of relief we provide after a natural disaster, where hopefully people can get bridged back to employment. But I think there's a high risk of a more traditional recession, sort of going well beyond travel, retail, restaurant, the sectors that are hit hardest now, and a relatively longer recovery.
So when you're thinking about this longer recovery, some of the expectations you made with these provisions for credit losses had to factor in a 9% unemployment. So now that things are looking that they might get higher, or they are getting higher than that, what does that mean for credit losses moving forward?
We calculate provision at the end of each quarter using sort of the economic assumptions from that time. So we'll do that again at the end of next quarter based on what we see in the economy. But, you know, Discover is fortunate. We've got a lot of capital, we've got a lot of liquidity, and so we're ready to support our customers through this.
You mentioned that you'd be cutting about $400 million worth of expenses, and that's without meaningfully reducing headcount in the short term. Where do all of those cost cuts come from?
So the majority are coming from marketing. There are a lot of marketing programs that just make less sense in this credit and consumer environment. But we're going after every dollar spent in a disciplined way, looking at vendor spend, looking at technology spend, but again, working hard to make sure we don't have any layoffs due to the COVID crisis.
So when you're looking at these expenditures, we all got so used to those rewards that all these credit card companies have given us across the industry. You hinted earlier this year that some of those things might be waning across the industry, and that was before the COVID crisis. Are rewards going to be a thing of the past?
So at least for our program, it's designed to be sustainable. And actually in the third quarter, we're featuring 5% rewards on restaurants for most of our cardholders, which we think should resonate well. I think some of the frequent flyer programs are going to struggle a bit as people don't want to travel. So it all depends on the program, but we have no plans to make any changes to our rewards program.
How do you expect to gain share in this type of environment? You mentioned that's something that you still wanted to do with reducing market share. Is M&A potentially part of the strategy now as valuations are lower across the industry?
You know, M&A is something we're looking at, primarily looking for acquisitions in the payments business. We own the third largest payment network in terms of acceptance locations, and clearly valuations in payments have come down. So that could be a way to grow Discover. You know, I think it's important to make sure that you're not just defensive, but also looking for opportunities that will come up.
That's incredibly interesting. How big of an acquisition would Discover be able to do?
You know, we have enough capital to support all levels of acquisitions. I think realistically, though, we tend to do acquisitions on the smaller side. And a lot of these emerging payments companies are, in fact, smaller compared to Discover.
Would you consider a sale?
You know, we feel very good about the mix of assets we have. We've got a balanced business model if you think about the banking side, funding and lending products, and a unique collection of assets and payments. So I'm really happy with the business mix we have now.
I want to go back into another interesting thing that's been happening over the last couple of months, 450,000 people skipping payments. What number do you think that looks like in the next couple of months?
So the good news is the peak enrollment for us was at the end of March, and we've seen customers enrolling in programs come down since then. A lot of these are short-term bridge programs, so it's going to come back to how quickly can people get back to work, and I also think how much the unparalleled government stimulus programs support the average consumer.